Hello again, everyone. This is part 2 of the series that I began last week as to why I have some optimism in spite of some of the recent events. I'm going to share some slides that were prepared and presented by Bert White of LPL at our recent national conference. So why don't we get right into it and turn to the first slide. What you're looking at here is, well, overall you're going to see that this has happened before. That is to say, a debt downgrade. And we see Japan in 1998, which was when they experienced their downgrade. It looks like it's happening again to them. But 1 month before it happened, they were down 9.6%. That's their stock market. On the day of the downgrade, it fell another 1.2%. Now, if you look at our market, the S&P 500 this year, 1 month before the downgrade, it fell 13.6% as that debt fight went on. And the day of the downgrade, it fell another 6.7%, which pushed it down over 20%. But look what happened in Japan after the downgrade. 1 week later, stocks had rebounded 6.2%, and 3 months later had pretty much held those gains. It was up 6.4%. As I'm recording this right now, the S&P 500 has already rebounded off of its lows. We'll have to see what happens 3 months later, but as you'll see in some slides to come, we think that things will be better by the end of the year. Is this anything like 2008? Well, let's look at 4 key things that we can use to compare. If you look at from the yield curve, headline inflation, consumer spending, and business spending, if you go down that middle column under the 2008-2009 recession, all of those numbers were negative. If you look on the right-hand side under 2011, what we're calling the soft patch of this year, all of those indicators are positive. Business spending is remarkably better, as is consumer spending. So much better overall in all those key indicators. Manufacturing, although not great, is also not in the basement. You can see just by these yellow circles how low it had gotten back in 2009. And even though we've seen some softness lately at a remarkably high level currently today, there's a lot of space between those two. Consumers have also gotten themselves in a much better position. They have much less debt. What you're simply looking at here is the debt as it's been paid down by the consumer, puts them in a much better position going forward. Consumer sentiment has also improved, despite the media's seeming enjoyment at reporting that consumer sentiment still is not great. We know that when it's above 60, it tends to mean better things going forward, and it's been consistently above that. What about 2010? Are we seeing possibly deja vu from what we saw last year? Here we're comparing 2010 to 2011. Both markets at the start of the year started out positively. This is the S&P 500. Then there was a natural disaster, the Gulf oil spill, I'm sure you'll remember. Markets turned around, went down 8%. After the Japanese tsunami this year, they went down 4%. Both spring and summers of these last couple of years, there's been problems and some reaction to the European debt issues. You can see in 2010, markets went down 8% in response. Just this past summer, down 18%. Afterwards, last fall, we saw a very nice turnaround, the post-Europe rally, we call it, up 18.8%. We'll see what happens this year. The end of the year return ended up being positive for the S&P, up 13%, and you'll see that it's predicted this year will end up between 5 to 10%. The year-to-date low had been negative 8.3% in July of 2010. This year it was negative 11%. So we see better things going forward. And finally, it bears worth considering, when does value start to matter to an investor? And what you're simply seeing on this screen is the trailing PE ratios of companies. And what we're seeing is that companies have not been valued this cheaply since 1989. This is a very powerful opportunity as far as I am concerned going forward. So I'll close by referencing one of my favorite coaches, Nick Murray. I'll be attending a conference that he's putting on in November, and he wrote a letter regarding that conference and threw this in. I thought I would share it. And by the way, this letter was from the second week of August. Last week I saw the confluence of three conditions. the earnings, cash flows, and cash positions of the 500 largest, best financed, and most profitable companies on the planet at all-time highs. The dividend yield of the S&P 500, however, momentarily, was higher than the yield on the 10-year Treasury note, and the fear-crazed mob rushed out of the former and into the latter. In other words, they rushed out of stocks and into those treasuries. That is to say, I lived a moment where, had I owned it, I could have sold the 10-year Treasury note, picked up 15 basis points of current yield, and gotten 10 years of earnings growth, increased dividends, and capital appreciation for free. And in their insanity, the suicidal lemmings were running the other way. While this was happening, the VIX, which is just a tracking of really market stress, was at 48. He concludes by saying, "Dearest friend, I've been in the business 44 years, 3 months, and 2 weeks. I've never seen the moon, the sun, and the planets and the stars line up in favor of the long-term equity investor quite that way. And whenever this is over, I never expect to see it again." That's my story, and I'm sticking to it. And my friends, that's my story, and I'm sticking to it. I expect to see this turn around and believe that patience will ultimately be rewarded. As per usual, please call me with questions, comments, reactions to this, and I'd be happy to discuss it. Until next time, thank you.